So, hi everyone. I'd like to begin by introducing myself. My name is Rufas Kamau, Markets at FX Pesa. I would like to begin by welcoming you to the session. Thank you for taking the time to join in. So remember, for today's session, we are looking at a market outlook, trying to understand what we're expecting to see this year, with a key focus on the next 3 months. So the first quarter will be very important in this session. We also need to understand the key market trends, developments, as well as key central bank changes that are happening right now. So once we understand all these, it will be easy for you and me to identify trading opportunities and trade profitably this year. So before we proceed, I would like to begin with a mic test. So if you can hear me clearly, kindly type hi on the live chat section, and these will confirm that everything is working just fine. All right. I think the chart section is disabled. So I can confirm from my co-host here that the voice is okay. So let's proceed as planned. So there is quite a number of developments that are currently happening in the markets. I'm sure that you have all been actively participating in the markets. So some of the things that we are seeing happening is a lot of central banks, right from the Federal Reserve Bank of the US, going to the ECB, the Bank of England, the Bank of Japan. All of them are trying to change policy in order to make sure that they are achieving their target or their mandates. So we will be looking at those central banks and the policies they're implementing to see a way forward. So we also be looking at the inflation problem and how it's affecting different economies, trying to see a way forward. And at the same time, we will also be looking at the major issue happening later today, and this is the issue of the US debt ceiling. So we know that the US has reached their debt ceiling. That is, they have borrowed so much, they have hit their limit, and now they are basically considering expanding their debt ceiling, and it has become a political issue. So we'll be following up on that to see more developments on the same. So without further ado, I'll begin by sharing my screen. Tashi, can you make me the host of the meeting so that I'm able to share the screen? Hello?
Sorry, just give me 1 minute. Let me make you the host.
Awesome. Now I'm able to share my screen. So I'm sharing right away. So among the key highlights that we have seen in the markets this year is a gold price starting on a very strong bull run, and this has continued quite persistently. So if you look at the price of gold right from the opening of the year, so remember, this is the 4th week of trading. So you'll notice that gold opened on a very strong bull run, and since then it hasn't stopped. So this was the price at the beginning of the year, around 1823. So a very strong jump on the first week of trading, pulled back, and then continued. A second week of trading, traded sideways for a while before breaking higher. A third week of trading, this is last week, attempted to pull back before continuing to push higher. This week on Monday, we saw gold dropping quite significantly before recovering and pushing even higher. So if you are to go to the 1 hour chart, then you notice the same idea. So yesterday, a very sharp drop, then a very strong recovery towards the evening, and today it seems to be going back. So it's a very strong momentum. It didn't start this year. If you were to use the 4-hour chart, then you notice that the momentum started all the way back somewhere around November last year. So we saw the price of gold hitting a triple bottom. So you can all see the pattern here, where gold goes down, faces support at 1614, goes back down again, faces another support at the same level, and then after the third drop retesting the same level, this was the beginning or the genesis of the current bull run that has continued in the market. So from 1614 all the way to the current price level of 1935, it's a very strong bull run. So if you manage to capture these, then we're in good, congratulations. And there's still more to come in gold. So currently, as we have seen, last year was coupled by a lot of things. One of the things that was basically dominating the markets is the fear as a result of the invasion of Ukraine by Russia. And from this happening, we have seen a lot of changes, people or investors normalizing the situation, whereas others are preparing for a potential point where the conflict could get even bigger. So from what we are seeing in the news is that a lot of countries are basically sending more equipment or artillery to Ukraine. And this is making the issue way bigger and causing a lot of fears in the market, whereas we would be seeing a potential case where Ukraine would eventually win the war and then start to attempt to reclaim Crimea from Russia. So one of the key things that we are considering is that before the start of the invasion of Ukraine, Russia was telling Ukraine not to join NATO. And in that case, it was trying to defend itself. Because if Ukraine was to join NATO forces, then it would basically allow the NATO countries to move their military equipment or artillery near to the Russian border. So according to President Putin, this was not acceptable. So for one reason or the other, he had to invade Ukraine. So what we are seeing here is the same exact thing happening. So we have seen the US send military equipment as well as artillery to Ukraine. France did the same, and yesterday Germany did the same. So what we are seeing is more and more NATO equipment and artillery moving towards the Russian border. So there's no telling that this will stop at this moment. So there's a good chance that the West will push to reclaim Crimea, or worst case scenario, even invade Russia. So it's a big geopolitical risk that everyone is considering. And as a result of this, we are seeing investors buy gold as a precaution, or basically caution themselves from that risk. So that's not the only reason we are seeing gold move to their trajectory. So the other reason that we are seeing gold move up is as a result So I just found it. Apologies for that. So central banks are buying gold at the fastest in half a century. And this is something that is quite worrying. So if you are a gold trader and you know that a lot of central banks are buying gold at the fastest rate in over 50 years, then you know that this demand is bound to drive prices higher. So what we are seeing since November last year, it's a very strong push to the upside as a result of these central banks buying more and more gold. So central bank gold holdings have risen since the global financial crisis of 2009. And what we are seeing is a stockpiling of bullion over the past 15 years, more than making up for the net sales of the previous decade. So central banks worldwide bought more gold in the third quarter of 2022 than in any other quarter in 55 years. So main reason that we don't have the data for the fourth quarter is that the data is not yet out. So in the next few weeks, we'll be seeing data for the fourth quarter, and then we'll compare these with the third quarter to see the rate at which these central banks are buying gold. So we know that a majority of the big central banks don't often report their gold purchasing in time, and some of them don't even report at all. So Central Bank of China, or the People's Bank of China, combined with the Central Bank of Russia, don't normally report on how much gold they are buying each and every month. So if we assume that this is still significantly higher, as we saw last year, then there sure is a very strong case for bullish momentum in gold. So this leads to the potential that we will see a complete swing happening in gold. So from the daily chart, you can see that the entirety of last year was driven by a strong bullish run at the beginning of the year. So this was happening in February. Gold rallied all the way up to around 2071. This is 2071 dollars per ounce of gold at 2069. So since then, gold embarked on a bear market. So remember, we normally market gold as the inflation hedge. So last year, inflation was very high, but gold was not gaining. Instead, it was losing, majorly because the US dollar was being used as the inflation hedge. So as the Fed started hiking interest rates in March, we saw gold continuously weaken, whereas the US dollar was strengthening as a result of the quantitative tightening by the Fed. So from March, for each consecutive rate hike, the dollar was strengthening, whereas gold was weakening up until we saw the bottom in November. So since then, we have had this strong bull run dominated by the Federal Reserve Bank of the US, as well as other central banks, hurrying to buy gold off the markets. So from what we are seeing here, it's a very strong swing attempting to complete a V-shaped pattern from what we had as the high of last year, around 2069. So from this run, there's a good chance that we'll be seeing a round number take a key part in gold trading. And the round number that I'm most interested in is 2000. So there's a good chance that we'll be seeing gold continue the strong run all the way up to the 2000 price level. So that's one of the key factors to consider, especially if you are a gold trader. So if you happen to do this intraday, that is, you buy and close your positions in the day, then you know that these opportunities tend to appear time and time over again. So there is a common patterns that tend to appear. So for instance, you can see there is a form of bullish channel that is currently happening in gold. So from this bullish channel, you're able to identify potential buying opportunities in gold. So for instance, if you look at yesterday, we saw the price of gold moving down, getting to the lower trend line, which you could have easily identified, and then forming a very strong indication of a reversal. So as it was going down, we had 3 candlesticks printing long tails to the lower side, then a drop here followed by a reversal towards the upper side. So after this happened, you can see the strong green candlestick was indicative of a bullish entry. And then from there, price managed to vary all the way up to the upper trend line, which was a very nice and easy trade. So you could have easily gone for a buy trade, set a take profit here, targeting to make 1765 points, whereas setting a stop loss of about 1100 points. So it was a very easy trade, especially if you understood the fundamentals behind gold. So when we talk about these fundamentals or the news that are influencing the movement of gold, then we basically try and identify a strong trend or a strong direction or a strong reason behind a market movement, and then we base our bias on that direction. So for now, the bias is that the price of gold will continue going up. So this gives you an advantage because you avoid the opposite direction trades. So when you know that long term, you're expecting gold to get to the 2000 price level, then you will not get involved in going for short selling trades. So in that case, you find yourself that most of the time you're going for buying trades along that direction, and that improves your probability of winning or having winning trades. But now that doesn't tell you where to enter or where to exit your trades. So in this case, if you are a momentum trader, you know that you are looking for value areas along the lower trend line. And in that case, they are easy to identify, and they have been easy to identify in gold for quite a period of time. So anything that gets closer to the lower trend line has been taken as a signal and has often come out as a profitable trade just by identifying these trading opportunities on the lower trend line along the trend. So in this case, what we are seeing here in gold is a pullback right from the morning trading. So price has been pumping and pushing further down. So in this case, if you are a gold trader, the most obvious thing would be to remain patient, wait for the price to get here. And once it gets here, then you potentially look for a reversal pattern or a sign that buyers have entered this market so that you can trade higher and target even higher prices. And that is assuming the same pattern remains and we continue seeing the same momentum in this price of gold. So, say this fundamental happening in gold, where central banks are hurrying or in a gold rush, each and every central bank is trying to buy more and more gold. There's more stuff happening in the markets, and we will be covering that on the next part. So, for instance, with Euro USD, I'll start with a bigger time frame. This has been the overall trend over the last 2 years, where the euro has been consistently losing against the dollar. So we saw for the first time the euro trading lower than the dollar, and this was quite impressive, especially for people who like extreme prices. So in our debt 2020, this was the exchange rate. The entire 2021, euro USD losing against the dollar, and 2022 even sharper fall in the euro against the dollar. So in between, you could find some very nice trend lines that were easily predictable. So you can see the sequence of lows that were following this particular path. And also, if you look at the sequence of highs, they were very easy to track last year. So this was an entire year. And to put this in perspective, if you understood the divergence between monetary policy between the ECB, or the European Central Bank, and the Federal Reserve Bank of the US, then you would have known that obviously this is the direction that the Euro USD will take. So knowing this information doesn't tell you where to enter or exit the market, but it gives you an advantage when you're making decisions on the side of stake in the market. So in this case, you should have looked for short selling positions in the market. So what we are seeing now is that inflation has remained significantly high in the Eurozone, way around 10%, which is very high, whereas the Federal Reserve Bank of the US is achieving its targets. Inflation has significantly fallen from a peak of 9.1%. The most recent data was 6.4%, and we're expecting even lower inflation in the US. So as a result of lower inflation, the Fed is slowing down the rate hikes. And on the next meeting, that is on the 1st of February, we expect the Fed to do a 25 basis point hike. So that's a much smaller basis point hike, considering that last year we were seeing 75 basis point hikes happening month over month. So with the Fed slowing down, the ECB has promised to tackle the issue of inflation. So we'll be expecting it to get more aggressive and do 50 basis points hike this year. And that is setting a divergence where one central bank is very aggressive while the other one is slowing down. So this sets up ground for a potential bullish momentum where the euro will be strengthening more than the dollar. And this already happened in September, then October, November, and December. So this year, we are already seeing the euro being significantly strong than the dollar. However, this is only a small portion compared to what we experienced in the last 2 years. So there's still more upside to play here in the euro or USD. So remember, the Fed is carrying a thin line where if it keeps on hiking interest rates aggressively, then there's a good chance it will put the US into a recession, and it doesn't want that to happen. So the Fed has several mandates. One of them is to stabilize prices through interest rates. That's what it has been doing by hiking interest rates. So the other mandate is to maintain full employment and also to maintain economic growth. So if economic growth goes to the negative, then that becomes a priority. And in that case, the Fed will be looking to cut interest rates rather than what it has been doing, that is raising interest rates. So in this case, we are seeing a continued movement to the upper side in the Euro USD. And in between the movements, there's always these predictable patterns that you identify that the market is making swings up and swings down that you can always use to trade intraday or even intra-week. So from the most recent price action in Euro USD, quite clear that we are trading in a channel. So this channel seems to be bullish, but at the same time, don't forget to notice that there was a time this was just a sideways momentum. So if I was to use a rectangle or a horizontal rectangle here, you'll notice that this was more or less like a sideways momentum rather than a trending momentum. So market goes up and then goes back down, up, down, up, down, up, down, where on one side this was a major resistance and this other side was a major support level. So eventually the market managed to break this resistance last week, pulled back down, and then this week you can see the continued momentum upwards. So there are predictable swings towards the upper side along this channel. And the idea is to look for when price is trading near or at the lower levels. So if price was to happen to get to this level, then it will create the right opportunity or the right idea, look for a bullish momentum and continue trading as price continues along this pattern. So the longer term perspective is that the ECB will be more aggressive in hiking interest rates compared to the Federal Reserve Bank of the US. So the euro could continue remaining strong against the dollar. So the same case happens to be the same for Australia, which is currently facing a very strong inflation. So from what we are seeing here, let me just remove these arrows. So the most recent data in Australia earlier this week was inflation flying even higher, basically forcing the Reserve Bank of Australia to get more aggressive with rate hikes. And this led to breaking of this upper trend line on the 4-hour chart. So AUD USD seems to be strengthening over and over. So that being mentioned, if you look at the daily time frame, you can see that for quite a period of time, the Australian dollar was losing to the US dollar. So it's quite clear for everyone that this has been the overall trend, with the exemption of this peak here. And then on the lower side, the overall direction was this way. So this was the overall trend in AUD USD on the daily chart, right from December 2020, so the entire of 2021, the entire 2022, the Australian dollar was just losing to the dollar. We saw an extreme price happening here, so an extreme sell-off dropping to 0.617. But then since this period, notice the correlation with Euro USD, October, November, December price moving up, and then in January closing even higher. So we have already reached a major target here, which is the previous high, and this was a high that we saw in August. And now price is currently testing this area. So it makes sense why we are seeing price slowing down around this area, since it's a major resistance level. So the idea is that the Reserve Bank of Australia will get more aggressive in rate hikes in order to control inflation in Australia. And with this aggression, then we expect the currency to continue strengthening against the dollar. So a potential break is loading here. And if the price happens to break this level, we know that price tends to retest these areas. So if there was a break straight out of this price level, there is a chance that the market would pull back to retest the area, since it's a major resistance, before continuing with a major continuation along that direction. So this is quite a normal technical pattern in the markets. You will most often see it happening. So case in point, if you look at this resistance level, which happened with the same resistance here, was tried and tested several times. Notice how the price went up and managed to pull back from here. So once it broke the level, it retested once and moved up, made another retest. This was the second time retesting the area before proceeding higher. So the same case could be happening here, where the market could break the area, retest, and then continue higher. So it's quite an expectation, especially if you're trading some of these breakouts. So the idea is that the AUD USD will continue moving higher, perhaps to even previous highs that we saw last year. This is 0.76590. But before we get there, there is an in-between resistance levels, such as this high. So we could see the market getting this high, testing the area, and then pushing even higher. So be prepared to see a much weaker dollar this year, as the Fed is preparing to stop hiking interest rates and eventually start cutting rates as we approach the end of the year. So those are some of the key takeaways that we have learned this year. So from the dollar index, we can already see that for the first 4 weeks of this year, it has been a bearish case. So having opened around here, the dollar index started with a very strong momentum before erasing the gains. Second week, some further downside. Third week, some oscillation here before closing lower. And then if you look at this week, we opened here, went up, 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 and then down, and today it's moving higher. And there's a good chance that this particular pattern will be continuing as the dollar remains weak across board. However, a key data to watch will be the FOMC press conference, the 1st of February, that is next week, where the Fed will be meeting and making a decision whether to hike interest rates or maintain them at the current level. So we are expecting that the Fed will do a much smaller rate hike of 25 basis points, which would push the US interest rates to 4.75%, very close to 5%. So after that rate hike, we will be following closely on the commentary from the Fed Chair Powell, as well as other Fed members, on how they see the outlook of the US economy. So with inflation responding as projected, getting slower and slower, then there's a good chance that the Fed will slow down on the rate hikes, and this could eventually weaken the dollar against other currencies. So the idea is now to look for strong currencies and pair them against the US dollar. So one of the strongest currencies that we are seeing emerging right from last year is USD JPY. So we know that Japan was the major loser among the currencies, where the Japanese yen was consistently losing against the dollar, and this had become a trend as a result of the divergence between the two central banks. So on one hand, we were seeing the US dollar being very strong against the yen. So this was the prevailing trend. So if you just woke up any day in last year and you bought USD JPY, then most of the days you would have made a profit since the overall trend was going up. So since we got to this peak here, where the Bank of Japan started intervening in the markets, that is at around 151 Japanese yen per dollar, then we saw the market reversing and taking an alternative direction. So from the forward chart, we can see that it has begun establishing a very strong bearish momentum that is marked by two trend lines, forming a very nice chart here that you can easily use to your advantage, especially if you are a USD JPY trader. So the outlook that we are focusing on is how the Bank of Japan responds to the current inflation that is currently rising, since this has been their major target over the last 20 years. So the Bank of Japan has been facing deflation, and as a result of that, it cut interest rates to negative 0.1%. And after cutting interest rates, it engaged in what we call quantitative easing, or basically printing more money and pumping them in this money into the Japanese economy to stimulate economic growth, as well as drive inflation towards the upper trajectory. So in the most recent inflation reading this week, we saw the inflation in Japan hitting 3%, actually 3.1%, and this is core inflation. So overall, overhead inflation is expected to be higher. So for provinces, we saw Tokyo hitting 4% inflation, And this is something that they are literally enjoying as a win, since they have not had positive inflation for the longest period. So with the Central Bank of Japan achieving its targets and getting some positive inflation, they are looking to make sure that this inflation is consistent. So they don't want to pull out all the activity they have been doing instantly, and then inflation drops back to the negative. But they don't want that to happen. So in the most recent BOJ meeting, they said that they will maintain the same policy of pumping more money into the Japanese economy, maintaining low interest rates at negative 0.1%, whereas they observe inflation and see whether it remains at that positive rate. So this led to a sell-off in the Japanese yen, and this did not last for long. You can see the small spike here. It was last week, but then we have continued to see this pattern remain the same, where the market remains within this channel. So now you can see the US dollar is attempting to gain against the Japanese yen as it approaches the upper trend line. So from here, it's easy to identify that there is a slow continued push towards the upper trend line. And once you get there, then the idea is to look for short selling positions, where in this case, we trade on strong Japanese yen against the US dollar. So the idea is to wait until the market gets here. Once it gets here, then we look for a longer term trade where we short the US dollar against the yen, and this could be a trade that lasts a week or two as you continue enjoying the strength of the Japanese yen against the US dollar. So it's a very noble idea just to wait for the market to get to the upper trend line and then look for signs for bearish entry. So once you see that sellers are entering strongly, then you go for your position targeting even lower prices. So I'm hoping that the chat session is now active. So if you have any questions, feel free to type those questions in the comment section, and I would like to respond to those questions right away. So at the same time, if it's not active, remember, you can always reach us. Try to address this directly to Dashi. Is there a way you can get responses via chat, either WhatsApp or via this Zoom session? Hello, if you can hear me, Tashi, can you respond? So going forward with the USD JPY, we expect some further continuation downwards. So notice it has been quite the same trend. So a sharp drop followed by a struggle upwards, sharp drop, struggle upwards, sharp drops, struggle upwards, and it's the same case here. So there's a good chance that you'll be finding a nice opportunity that could last a week or two, shorting the US dollar against the Japanese yen as a result of the divergence between the two central banks. So there is increased pressure upon the Bank of Japan to cut the quantitative easing program since they have achieved their inflation targets. And once this happens, then it is a basis to start buying the Japanese yen. We know that the markets are forward-looking, so it could have already started back in October, and this could be a continued trend for the year. So the Japanese yen is expected to remain strong throughout the first half of the year. Then we'll do another outlook trying to understand the second half of 2023. So besides this, there's more content. Remember, one of the most traded assets in the FX space is oil. So we'll be looking at UK oil, or what we call Brent oil. It's the most largely traded oil market, and it kind of causes a lot of volatility in the markets. So it's very important we understand how this works. So good comment. Yes, I see the comments are active. Thank you, Rono. Last time, the Bank of Japan measures didn't hold for long. Should we be skeptical about the current move as well? The thing that I'm very skeptical about with the Bank of Japan is what they are doing right now. And this is basically maintaining the same policy despite achieving their targets. So remember, the target was to hit an inflation that is significantly above 2%. So now the inflation is in Japan has already broken the 3% mark and is on the rise. So if they continue holding the same policy and pumping more money into the Japanese economy, then the inflation will become a big problem for their country, and they don't want that to happen. So remember what happened with the US as it continued pumping more money into the economy through the COVID period, 2020 to 2021. In 2022, the inflation was rising, managed to vary from a low of about 1.5% all the way up to 9.1%, whereas for Eurozone, it went above 10%. So Japan doesn't want this to happen in their economy, and the only way they stop this from happening is by cutting the quantitative easing program they currently have. And it's basically assuring the investors that they are no longer printing Japanese yen. And when they assure us that, then we basically start buying the yen against other currencies. And I think that will be the trade for this year. So the idea is now to look for the pair, the alternative pair, where if you're buying the Japanese yen, then you need a very big currency to pair that against, and that would create the next trade for this quarter. I hope that makes or answers your question, Ronald. So thank you for the question. So UK oil, we know that it was strongly bullish the entire of last year, but this year, as well as the second half of last year, we saw UK oil pulling back downwards. I don't know why it's taking this long. Yes, so now I have the right chart. So this is what happened last year. So let's mark the beginning of last year. So this is it. Price opened at a very low price around here. So managed to make a very strong bull run, especially as a result of the fears resulting from the Russian invasion of Ukraine. So at one point, we saw the Brent trading at a price level of around $130 per barrel. Then price pulled back down and then up. And then around this area, we saw central banks or governments tapping their strategic oil reserves. So we saw the President Biden tapping the US strategic oil reserves. This meant increasing the supply of oil in the markets, which drove prices way back down. So from March last year, we saw consistently price of oil going back down. And towards the end of the year, the price was trading very close to the opening price of the year. So notice the opening price at the beginning of this year versus last year. So all these gains had been eliminated. However, on the wake of the new year, that is this year, we are seeing a very strong run as a result of market activity and bets on a strong oil market. So main reason we are seeing this is that there is a continued expectations that oil will remain hot this year. So what we're expecting is one, the Chinese economy seems to be very vibrant right now. As a result of what we saw, the Chinese taking a U-turn on COVID-19 policies. So China has been doing a zero COVID policy since the beginning of COVID. And this has led to a lot of restrictions that have hampered economic production within the economy. However, in December last year, they basically decided to remove these restrictions. So this year, we are seeing a much more open and vibrant Chinese economy, despite the rising COVID-19 cases. So they are beginning to adjust to a situation where they are now living with COVID, just like other economies in the world. And this is being taken very positively in the market. One of the main factors is that China is the biggest importer of oil. So if economic activity is high in China, then oil demand is often high as well. So India is also another big country that is a major importer of oil. So the economy seems very vibrant as right now. So we expect the demand or the outlook for oil demand to continue rising. and this would set the bottom line or the basis for a bull run in oil this year. So notice that the price is still within pattern. So there's still a major trend line here that has been holding for the past couple of months since July last year. So the current rally is headed here. So potentially this year, this month, we could see the price of oil hitting $92.8 per barrel. But then it's also very important that we look at the supply side. So yes, the supply from Russia was eliminated from the markets. And also we have the Russian oil cap, which is currently at $60 per barrel. So with oil prices trading at 87.4, Russian oil is being bought at much lower prices. And this is quite a big problem in the markets. So the OPEC, which is basically the cartel controlling a majority of the supply of oil in the world, decided in their last meeting that they are going to continue with the oil output cuts at a rate of 2 million barrels per day. So these output cuts are basically out to cut or stretch supply to make sure that the prices remain on the upper side. So the OPEC countries majorly depend on revenue from oil exports to fund their economies. So it's within their interest that oil prices remain high so that they can get more revenues for their oil. So to do this, they turn up this cartel and they cut the supply in order to push prices higher. And this has been the order of the day for the entire of last year. So while Biden was tapping the strategic oil reserves, it was quite an intelligent play. Remember, they had their primaries happening last year. Sorry, not primaries, but the midterm elections. So it was very important for Biden to make sure that oil prices are low. However, the US oil reserves are not infinite. And in the next couple of weeks, I'm talking about the next 6 to 8 weeks, the US will have run out of reserves if they continue tapping the reserve. And this basically means that they will have to go back to the market to buy more oil. So this means that there's a good chance that there will be a rally or as well as an oil rush for countries rushing into the market to buy more oil to stock or to restock their oil reserves. So in this case, this builds a very strong case for oil momentum. So notice that oil has been on a bull market since the record low that we saw in 2020, when oil was trading at $19, and this is Brent oil. For US oil, it was $8 per barrel. So the bull run continued through 2020, 2021, 2022, and then the pullback as a result of the intervention by central banks. But now we are looking at a potentially another bull run after this bottom that we happened to see in the last 2 months. So December and November seems to be the bottom. So despite forming lower lows, the low that we saw in December was significantly higher than the low in November. So this was an indication of the weakness in the trend. So from a technical perspective, this was a change of trend. So now potentially we'll be looking at oil prices confirming the new trend by forming a higher high. So most recent high in December has already been broken. So also we look at the one for November here and also November here. So there's a good chance that the market will break 92 and even move to $100 per barrel. And this will create the necessary momentum even higher. So my projection for oil is that we recover and see the same highs that we are seeing last year. So potentially the beginning of this pattern here. So this is potentially $105 per barrel as well as $100 per barrel. So this is being determined if oil happens to break the $92 level. So there's a good chance we'll be seeing some more upside in oil, especially as demand continues rising and supply remains suppressed by the OPEC countries. So going forward, the key fundamental factors to focus on is the OPEC Plus meetings and what they decide, and two, the global outlook, and this is in terms of demand. So if you see a strong Chinese economy, meaning that the production is high, strong factory activity in China, Japan, and other economies, then this means more demand for oil and potentially higher prices. So that's one key thing to consider, especially when you focus on oil markets. So lastly, as we approach the end of the presentation, we'll also be looking at equity markets. So I'll begin with the S&P 500. So the S&P 500 has been quite resilient this year. So the entire January has been quite strong. But then, if you look at the entire on last year, it was a very strong bear market. So beginning at an all-time high and then dropping gradually for the rest of the year. However, this year we are seeing this particular trend line from last year being broken, basically indicating that there is a potential that the S&P 500 will move up higher. So this is what we saw last year. So a couple of swings right from the beginning of the year, and all those swings were forming lower lows and lower highs. So we saw a very sharp bottom here. Then since then, you can see that the most recent lows are now getting higher. So this is an indication of a potential change in trend. So the main reason that this change is happening is as a result of Fed policy. So the bear market was majorly spearheaded by the Fed being aggressive in hiking rates. Now that the Fed is slowing down the rate hikes, then potentially we are seeing a strong equity market and a weak dollar. So the S&P 500 is breaking this resistance and moving up higher. And we're expecting this particular movement to continue, at least for the foreseeable future. So the most recent highs to think about would be this level that we saw here in November and December. So 4,100 seems to be a nice target if you're a shorter term trader trading intraday or even intra-week. This could be a very important target for you. However, judging by what we are seeing happening in the US, we are seeing companies that are breaking records and in terms of earnings. So yesterday we saw Tesla breaking records in terms of earnings, making or achieving an earnings beat. Also the revenues were above target. So the day before that, we saw Tesla also doing the same, showing some impressive results. So there was a slight miss with Microsoft, but still very strong profit and very strong earnings growth. But then, on the other hand, these companies are cutting their staff or their jobs, and this is a big red flag in the markets. So whereas the companies are achieving their targets, they are basically cutting their staff, meaning that they are not prepared to expand production further. On the other hand, we are also seeing the companies revising their outlooks to the lower side. So this, the CEOs of these companies are basically expecting a recession to happen in this year. And by responding to those expectations, they are creating the recession themselves by creating unemployment and so on. So despite having this breakout happen in the S&P 500, at some point, we may be expecting the stock market to crash further downwards. And this is mainly as a result of how these companies respond to the tough economic environment. So remember, the bull run that we saw in 2020, 2021 was as a result of easy monetary policy. So from the bottom here all the way to the top, this was the beginning of 2020. This was the stock market crash in January through March of 2020. Then the recovery, 2021, 2022. So during this period, the US was printing loads and loads of cash. At some point, it was giving stimulus check worth of $1,400 to each and every unemployed person within the economy to boost demand in the economy. So what we are seeing here at the end of this bear market is a strong recovery, but the recovery is not based on the conditions that were there at the beginning of this bull run. So at the beginning of this bull run, the inflation in the US was around 1.5%. And at the same time, interest rates had been cut to 0.25%, and there was quantitative easing. So the difference between this period, which was the bottom, which marked this 2-year bull run, is not the same with what we are seeing here. So inflation is still significantly high, above 6%. The other thing, we don't have quantitative easing. So nobody is printing more money and pumping money into the US economy. And at the same time, interest rates are extremely high at 4.5% compared to 0.25% in the previous period. So this is not the right macroeconomic environment to see a very strong bull run, such as the one we have just seen here. So you wouldn't assume that this market would form something similar to this because the conditions are not right. So with that in mind, then it basically means that the bull run we are seeing here is only fake. It's a bull trap. So at some point, the overall projection, and this is my own opinion, is that the S&P 500 will continue pushing down as a result of the pressures from the current economic conditions. So one of the pressures we are seeing in the market right now is the prices of housing. They are going down. So with housing going down, remember that housing is a major employer. As long as there is expansion in housing, there is capital-intensive projects, there's labor-intensive projects. So housing creates a lot of employment. And if housing is going down and slowing down, housing prices are going down, new home sales are going down, new constructions are going down, then you don't expect the economy to expand as much. So tech companies are the ones that are leading the market in terms of firing staff. So we saw Google firing over 12,000 employees, Microsoft 10,000, Facebook 12,000, and so on. So with all these firings happening, these companies are preparing for bad times. So with that in mind, we're expecting growth or economic growth to be slowing down. And also the strength of the US consumer is weakening. So with higher interest rates, it doesn't just happen to affect the real estate market, it also affects consumer spending as well as credit card debt. So you find that more and more Americans are taking credit card debt at even higher interest rates. And eventually, these will take a toll on their purchasing power. And remember, the US economy is based on the consumer having more purchasing power. So if the consumer has less purchasing power, then the companies make less sales, less revenues, and this eventually boils down to a weaker stock market. So while we may be enjoying a very strong bull run here, eventually the idea is that the bear market continues until these conditions change. And when these conditions change, we'll be seeing the Federal Reserve Bank of the US cut interest rates, start to do quantitative easing, and that will mark the bottom and potential for another bull run similar to what we saw here at the bottom of COVID-19. So as per now, the overall outlook for this year and this quarter is that eventually the S&P 500 drops. And this is not just the case of S&P 500, it's also the case for US Tech 100, the Dow Jones, and most importantly, the UK 100 or the FTSE 100. So the UK 100 is the most ridiculous one right now. Sometimes the market can be very ridiculous. So the ridiculous case for UK 100 or the FTSE 100 is that the market is forming higher highs. So these higher highs are basically almost equivalent to the all-time high that we have ever seen in the FTSE 100. So the all-time high is around this area. And as you can see, the market almost hit an all-time high of 79.10. So if the market breaks here, this will be the all-time high for the FTSE 100. However, the big question that we're asking ourselves is that is the economy at its all-time best? Is the UK economy this strong that the stocks are performing their best ever performance? So the question, the answer to this question is no. It's not at its all-time best. The consumers in the UK are really suffering from the high energy bills. Inflation is very high at above 10%. And in this case, the stock market is completely overvalued. So there is a good chance that we'll be trading a very nice position. And I think this will be the best opportunity proposal for this session today, that eventually the UK 100 or the FTSE 100 will be dropping back down. And this is something that I'm willing to bet on. Of course, if you are a trader out there, you know that you have to practice risk management. So you have to be prepared for this. But then the moment we start seeing bears entering this market, then there's a good chance we'll be seeing some further downside. So one of the key indicators for reversal in this one will be one, the Bank of England will have to be very aggressive in hiking interest rates to control the high inflation. And as long as Rishi Sunak goes for that strong rate hike, then the idea will be to short the FTSE and target even lower prices. So this seems like very nice trading opportunities that could be happening over the February, March, which basically represents the first quarter of this year. So thank you very much, guys. Thank you for your time. I hope I was able to create value in this particular session, and I'm looking to provide even more value in our daily updates in the VIP channel, as well as more to come. So thank you very much, everyone. Thank you for your time. I hope to see you on the next session. Thank you, Rono. Thank you, Tobias. Thank you, Kevin. I appreciate you guys.